Welcome to today's Federal Budget 2020 to 2021 live webinar. Presenting today, we are joined by Eleanor Kasapidis and Gavin Ord. Chairing today's webinar, we're also joined by Ketty Waller and Peter Wilson. Supporting in the chat box, we also have Kimberly O'Hayan. Now, I'm just going to go ahead and welcome Ketty into the conversation first. Ketty, I've just opened up your mic. Good afternoon.
Good afternoon, Linda, and hello, everyone. My name is Ketty Waller, and I'm the Head of Public Practice here at CPA Australia. It is my pleasure to welcome you to our Federal Budget webinar today. Before I introduce our presenters, I would first like to introduce Peter Wilson, Director and immediate past President of CPA Australia, to provide an update from the board. Thank you, Peter.
Thanks, Ketty, and good afternoon and welcome, everyone. I'd like to start by acknowledging the traditional owners of the land in which we meet today and to pay my respects to elders past, present and emerging. We are across at least 4 major capitals in Australia, so our respects go to the Boonwurrung and Wurundjeri people of the Eastern Kulin Nation, the Gadigal people of the Eora Nation, the Turrbal and Jagera people of the Meanjin Nation, and the Whadjuk people of the Noongar Nation. And also our acknowledgements and respects are paid to any Aboriginal and Torres Strait Islander people who may also be present with us today from the other great nations of the First People in Australia. Welcome to you all, and thank you for joining us right around Australia. I'm delighted to be part of this special event for our members, which is our policy and advocacy update on the 2021 budget that was delivered by the Treasurer last night. This session will provide members with an analysis and an overview of key measures of the budget, which was handed down by Treasurer Josh Frydenberg. Today's presenters, Eleanor Kasapidis and Gavin Ord from CPA Australia's Policy and Advocacy team, will provide updates on the latest developments, tax issues and outcomes of the budget. Of course, the numerous major events of this year have had a momentous impact on the global and the Australian economy, and consequently the budget has been delayed 5 months and takes a much different shape to what we would have expected at the time of the last budget. It is Australia's first recession-era budget in almost 30 years. CPA Australia asked government to provide an expansionary budget which funds policies and measures that support productivity, employment and GDP growth without compromising long-term environmental sustainability. I look forward to hearing my colleagues' take on the budget and whether these outcomes have been achieved or are likely to be, as I'm sure you are too. But also a bit of an update on our support for members during COVID-19. The CPA Australia Board is acutely aware of the significant pressures you're all under, the work you are doing, and the importance of the advice and guidance that you are providing to your customers and clients in the current environment. So at CPA Australia, we want to and we will continue to support you by providing the best information we can and the resources and the tools that you need to help you do your job. We have a dedicated COVID-19 hub on our website that features a wide range of resources to assist you and your clients respond to the impact of COVID-19. We know that you may also be playing an important role in supporting your clients and also your co-workers and staff who are experiencing challenges and particularly mental health problems during this pandemic. CPA Australia has developed a mental health toolkit with useful links to mental health information, resources and support, which is also available on our website. A final reminder, our Congress this year will be an interactive online experience over 3 days, from the 10th to the 12th of November. We have a terrific group of speakers, 2 in particular you will know as household names, Ben Bernanke, the former chairman of the Federal Reserve in the US, and also Amal Cooney, the human rights lawyer based in Europe. So I encourage you to check out the program in full and register to attend, having looked at the information on the website. So, ladies and gentlemen, here today, I hope you value the investment, enjoy this session, and I'm pleased to now hand back to Ketty. Thank you.
Many thanks, Peter. As Peter said, 2 of our policy and advocacy team, who have actually spent the night and some of the early hours of this morning going over budget papers, will take you through an update of today's federal budget. Firstly, I'd like to introduce Gavin Ord, Manager in Business and Investment Policy, who is also the Policy Lead for Asia at CPA Australia. Within CPA Australia, Gavin has responsibility for the development of policy, research and advocacy issues related to business and the economy, including small to medium-sized enterprises and regulation in Australia and Asia. I would also like to introduce you to Eleanor Casapidis, CPA Australia's Tax Policy Advisor. Eleanor is responsible for the development of policy, research and advocacy on issues related to tax policy, legislation and administration in Australia and internationally. She leads CPA Australia's Taxation Centre of Excellence and represents CPA Australia on a variety of tax-related forums and groups. Eleanor also spent 17 years at the ATO before joining CPA. Just before I hand to Gavin, I would like to flag that while there were many key announcements last night, as we often know, the devil is in the detail, which we may not see for some weeks, although there have been a number of bills introduced today. So while we will do our best to answer any questions you may post in the chat box at the end of today's presentation, there may be some we may not be in a position to answer straight away. And with that, I'd like to open our session and hand over to Gavin. Thanks, Gavin.
Thank you, Katie, and hello to everybody in Australia to listen to today's webinar. I hope you do get something from it. So what I'll do is I'll just start off with an overview of some of the key policy announcements from today, or last night's budget. Most of these will go into some detail. Some of them we won't cover in that much detail. So, for example, I will speak on the infrastructure component of what was in the budget, and Eleanor will speak to what JobMaker and the expansion to instant asset write-off and the personal tax cuts. On health measures, obviously there's an increased spending on health, and that's to be expected. And it's not just around COVID-related issues, there are also increased spending on mental health issues as well. And I'll also talk briefly about some of the spending on the environment. One thing to note about this budget is it is a reactionary budget. It's not a visionary budget. It is a reaction to where Australia is at this point in the economic cycle. So it's not to be surprising that, given that it is an expansionary budget, that we are seeing a huge deficit. And we expect the deficit to be, or the government expects the deficit to be around about 213, 214 billion in 2021, which represents 11% of GDP. That is not a usual budget deficit. That is extraordinary. That is an extraordinary budget deficit in a peacetime economy. But given the state of our economy and the incredible uncertainty which we still face, it is the right approach at this point in time. So to give you a bit of background on where we are economically, the government is forecasting that the Australian economy will shrink 1.5% in 2020-2021. But to be more precise, so for the 2020 calendar year, the government is forecasting a contraction of 3.75%. Now, if you compare that to other developed economies, it's not too bad. It's roughly in line with expectations for the US, but better than most of Europe and Japan. Obviously, China has now begun its recovery, and the recovery is quite strong, whereas in India in the last quarter contracted over 10% as COVID cases there start to spike. So where are we at the moment? So the budget papers state the economy is on the way up again. I'm not saying it's fully recovered, but we've reached the bottom and we're now starting to recover. And they're forecasting that economic activity will pick up strongly from late 2020 and into early 2021. And a big component of that is not only the spending in this budget, but also the reopening up of the economy. And I'm in Melbourne. I'm very much looking forward to the reopening of the economy in Melbourne. And the government, as the government states, that they expect that this budget will significantly support the economic activity. Obviously, that remains to be seen, but it will definitely contribute to that. So we are in this situation where the economy is doing better, but it's still at a low ebb. Now, we're having, as I said before, we have our budget deficit around about 11% of GDP. But we're not, and also we'll see later on that the forecast is there will be budget deficits for as far as the eye can see. So for the remainder of this decade, the government is forecasting budget deficits. But that's the right approach at this point in time. We're not calling out as a bad approach. We're not calling out the wrong approach. We're saying that given the economic circumstance is the right approach at this point in time. I also do note that government debt is at its lowest level in 5,000 years. For example, the yield on Australian government bonds is currently below 1%. Now, the economic impact, the deficit is not just about government spending, but also reduction in tax revenue. And the tax revenue is expected to be down 1.7% in this financial year. But on the other hand, government spending is forecasted to rise 15% in this financial year, mainly on the back of JobKeeper extension and to some extent the extension of the instant asset write-off. But also, government spending is forecast to increase 15% this year, and the following year it's forecast to decrease 16%. And that is, again, because JobKeeper comes off mainly. Other things to note in here is the unemployment rate. So you can see the unemployment rate is forecast to reach 7.25% by June next year. Government is forecasting that unemployment will peak at around about 8% in the December quarter. And so they're expecting the unemployment rate to go back up now that JobKeeper has come off for many businesses. But yeah, from December this year, they expect the unemployment rate to gradually decrease to around about 5.5% by June 2024. Overall, the government found that the forecast unemployment in this budget are actually lower than their July forecasts, reflecting both the positive outcomes on employment in July and August for everywhere except Victoria, but also the significant support that the government has put into the economy, particularly JobKeeper. Now, with unemployment remaining high, obviously wage growth is going to be low, but the personal tax cuts will at least buffer some of that low wages growth. Also interesting to note is that Eleanor will speak about the incentives for capital investment. But even in spite of that, the government is forecasting a nearly 10% decline in capital investment in this financial year. Gross debt, and obviously this has to be paid for, gross debt is expected to be at nearly 45% of GDP at the end of this financial year and increase to around about 55% of GDP over the long term. This chart here shows the underlying cash balance, which is, in other words, deficit. The dark line represents the forecast from last night. The grey line at the top represents the forecast from December last year. So if you see the grey line at the top, in December last year, pre-pandemic, pre-bushfires, we can see that the government was forecasting surpluses for, sorry, I need to change the slide. So I'll go back there. So the dark line represents the budget forecast from last night. The grey line represents the forecast from December last year. You can see in the grey line that in December last year, the government was forecasting surpluses throughout this decade. Post bushfires, post the pandemic, we can see that we're going to be in deficits for the foreseeable future. This slide here shows net debt as a share of GDP. Again, the grey line represents the forecast from December last year, and the darker line represents last night's forecast. You can see that the government in December last year was forecasting that we would basically get into a net asset position rather than a net debt position by the end of this decade. And obviously that's not going to happen with the huge increase in borrowing that the pandemic has triggered. Now, obviously, the next question that flows from this huge increase in borrowing is it has to be paid for. So when looking at interest expense, this shows the forecast interest expense from last budget to this budget. And as you can see, if we go back, I'll just go back a few slides, you can see here that the net debt is forecast to increase from last financial year to this financial year by 200 billion, over 200 billion. And yet the interest expense is only going up marginally. Now that's because in the last budget, the government's forecasting its interest expense, well, the interest rate at around about 2.5% to 3%. The government's now paying its interest rate is around about 0.8 to 0.9%. So while it's borrowing a whole lot of extra money, the cost of that money is a lot lower. So obviously the government's now also busy refinancing some of its older debt. And one question is, who do we borrow from? Well, we borrow, the Reserve Bank is buying up a lot of this debt. So the Reserve Bank is buying up a lot of this debt as part of a quasi-quantitative easing, but also banks and others buy up this debt. And you have to remember that Australia still is AAA rated and therefore is one of the prime targets for people wanting to buy a safe asset. Also, if you look at other countries like Germany and Japan, they actually have negative rates on the yields. So it's actually cheaper for them to borrow than to raise taxes. So what is the context? This is from the budget paper, and I think it means it shows really the situation. And I'll just read it to you. There remains substantial uncertainty around the global domestic outlook, as well as the extent of any longer lasting economic effects of the pandemic. This stems largely from uncertainty around the spread of the virus and the success of health interventions, as well as uncertainty around the timing and efficacy of vaccines and other medical treatments. Uncertainty and reintroduction of containment measures could also substantially reduce activity. And you would see that in Europe over the last few weeks there's been a recent spike in cases. So definitely could come back and we should be focusing in on that. Also overnight the IMF released some statements, and it said in terms of the global economy is coming back from the depths of the crisis, but the calamity is far from over. The path ahead is clouded with extraordinary uncertainty. Faster progress in health measures such as vaccines could speed up the ascent, but it could also get worse, especially if there is a significant increase in severe outbreaks. And yesterday, the Reserve Bank, in its monthly statement, said that the national recovery is likely to be bumpy and uneven, and it will be some time before the level of output returns to its pre-COVID levels. So we are in still a very uncertain period, and this is what's shaping the context of the budget. I'll now pass over to Eleanor to speak about tax.
Thanks, Gavin. So tax, as always, was part of the government's response to COVID-19, and a lot of it had been discussed in the lead up to the budget. The tax bill is actually now before Parliament, so if you wanted to go and have a read of it and look at the detail, it is there. I won't pretend that I've had a thorough look, but the following slides will just be about covering the announcement, and we'll work through the detail in the coming days as we navigate the legislation. So the big one was around bringing forward personal income tax cuts. So stage 2 have been brought forward. The tables on the slide just show the difference and the shift in the tax brackets. We're very happy about this. It's something that we called for, certainly to bring forward the stage 2, if not the stage 3 tax cuts. And we think the government's chosen the sensible option. So they know that this change will get through, and that makes things a whole lot easier. So in terms of bringing those forward, what it means is that those earning $45,000 up to $120,000, you can see those changes. And then we look at the bottom end, so the low income tax offset and the low and middle income tax offset. So what the government has done there is increased the low income tax offset. So this was the one that was supposed to in a couple of years kind of consolidate anyway. And then the government has also decided to retain the low and middle income tax offset for another year. So that what that does is actually give millions of Australians a one-off bonus. So those between $45,000 and $90,000 income a year will get around $1,080 tax benefit. For those earning $120,000, it becomes around $2,400. So there are tax calculators. I'm sure the ATO is busily uploading the adjusted amounts, and people can go and check how much they actually will receive. So that's the whole combination, and we'll look through the legislation and the implementation. We intend to work with the ATO. I signalled in some media interviews this morning and the podcast that we would expect the ATO would adjust the withholding table. So instead of waiting till the end of the year for taxpayers to get the refund of the tax that's been paid at the higher rate or withheld at the higher rate for the first 5 months, we would expect changes to the withholding amount so that people can get those balancing amounts in their pockets faster. So those are the personal tax changes. There were also some small changes around exempting granny flat arrangements from CGT. I think the Board of Tax did a review of that quite recently, so that's going through. And there were some extra payments for aged pensioners. Gavin and I were discussing this morning that really on the job seeker front, on the welfare front, there wasn't anything big in this budget, but we do have small payments being made as well. That's personal tax. Then we have business tax. Really what the government seems to be focusing on is established businesses and those that have money to actually invest in capital assets. So, or have paid tax in the past against which they can offset tax losses. The temporary full expensing of purchases of depreciable assets is a big one. So because you're lifting the threshold up to $5 billion to claim a full deduction, that's a huge upfront tax benefit. The government's acknowledged, obviously, that this is just a timing thing. It's bringing forward those amounts, but it still is a significant measure. It's also been pointed out, of course, that if you do this investment, you do the deductions and you end up in a taxable loss position and you're a company, you may actually then be able to take advantage of the carryback arrangements to obtain some credits from prior year tax paid. So there might be, for some, an additional benefit or a double benefit. Businesses with a turnover of under 50 million can apply the full expensing to second-hand assets. For larger businesses, obviously, that's just for the new assets. Tax loss carryback, we're pleased to see this. It's something that New Zealand introduced, other regimes have it, and certainly this is the kind of time that you'd want to see it tested out. So losses from 2020, 21, 22 income years can be offset against 2018, 19 profits or later income years. As I understand it, that will be an item that is claimed on the 2021 or 22 tax returns. So it's not something that companies can access immediately, but it's done through the tax return lodgement process. On R&D, we've got the changes. I think it's a really positive step. So CPA Australia, along with a lot of other associations and members of industry, were really concerned about the R&D bill that was before Parliament and before the committee. So we're very pleased to see that the $4 million cap on the refunds is being lifted. We've got the refundable offset being set at 18.5 percentage points above the company tax rate. And the number of intensity tiers being reduced from 3 to 2, while it might be sort of quite an intellectual conversation for some, for other businesses it makes a huge difference. So seeing that consolidation at least back to 2, if they're going to go ahead with it, then that's better than nothing. So that was a positive step. Obviously have to read through the detail and see what it actually means over the longer run, but it's good that the government is recommitting to R&D. So the other one is the extension of small business tax concessions for businesses with a turnover of up to $50 million. So essentially what they're trying to, or starting to do, is to standardise that definition of small business, which once again, this is something that we've been looking forward to. You know, the provisions are complex enough without having different thresholds for different things. So this unification and this idea of a base rate entity and starting to align the provisions and concessions with those concepts is a step in the right direction. It does streamline things and it does make things at least a little bit simpler, because you're talking about conceptually the same sort of things at once. It will be done in 3 phases. So backdated to July, we've got immediate deductions for startup expenses and prepaid expenditure. Then from next year in April, you've got the exemption from FBT on car parking and work-related portable devices. So that is a good one. I know that we made a submission to the ATO about just the administration of some of the car parking FBT rules, and this might actually help remove that obligation from a large number of companies, especially those that are providing car parking to their employees because of COVID-19. And then from next financial year, 1st of July, the eligible businesses will have access to a range of other concessions, such as simplified trading stock, GDP-adjusted notional tax-based pay-as-you-go instalments, 2-year amendment period for tax returns, and simplified accounting method determination for GST purposes. So I did just notice the question just around the existing pool balance will need to be written off. In the papers, it noted that for those using simplified depreciation, they can, but there is currently, you don't have to. So in terms of if you choose not to, normally you would no longer be able to use simplified depreciation, but my understanding of how it was in the budget papers was that you would still have access. So I know there were some concerns from some that you'd have to write the whole full balance off under the instant asset write-off, and I think that the government's tried to be a bit clearer this time in their documents. Other business tax announcements. The Victorian government, I know this is really interesting in terms of their business support grants have been specifically defined as being non-assessable, non-exempt, and so effectively that's a tax break for Victorian businesses that receive these grants. There's some additional funding to target serious and organised crime in the tax and super system. It'll be interesting to see how that is applied. So we've got so many different areas at different levels, and there's been so much work with AUSTRAC and some of the other agencies. It's interesting to see how they develop those activities. The corporate residency test, they are trying to clarify following the Board of Taxation review, and I think that'll be quite welcomed. Once again, it is a complex area and the interaction sometimes can be difficult to unpack, so we'll see how much that helps. And the FBT exemption for employer-provided retraining and reskilling benefits provided to redundant or soon-to-be redundant employees. I think this really, you know, I was talking to Accountants Daily yesterday, and just this idea of FBT more broadly, the system needs perhaps to have a look at both its design as well as the compliance costs and how it's administered. Similarly, work-related deductions and education expenses have the same sort of paradigm. And in this environment where people are always reskilling, they may be being made redundant and need to retrain, what is the role of the tax system in enabling that, and how should that be funded? So I think it's a step in the right direction, and certainly will assist those employees to be retrained. So there's some compliance improvements for FBT. Once again, we're waiting for the Board of Tax report to be released by government. I would suspect this was one of the recommendations that was given to them, so they've just acted on it. But it'd be nice to see the whole thing and see what else is there. There's just also some information sharing agreement information there. So with that, Gavin, I will hand back to you to talk about JobMaker.
Thank you, Eleanor. Thank you, Eleanor. So JobMaker credit was announced last night as well, so a hiring credit. So it's designed to provide some incentive to hire recently unemployed people, and it's focused in at people under 35 and under. So you can see there, it is a 12-month payment. It begins from today, and it only applies for each additional job that's created. To be eligible, the employee must work at least 20 hours per week. That's averaged over a quarter, and the employee will need to have received job seeker payment, youth allowance, etc., in at least 1 month of the preceding 3 months. So if you take someone straight from university or straight from high school, this doesn't count. They must have to have been on some sort of welfare payment immediately preceding them getting your going into employment. Also, as I said, there's an age difference, and anyone over 36 and over does not get access to this payment. It's obviously aimed at the lower, at people who are younger, so $200 per week, which comes out to just over $10,000 a year. So we see this as, at this point in time with our engagement with the members, particularly at the smaller end, that not many businesses are really thinking of increasing their headcount at this stage. But it does run until 2022, so maybe towards the end of next year that this might come in handy. But again, it's an incentive. It will have some benefit in some industries, but maybe not all industries. And so its impact is not going to be as large as what people think, maybe what the government claims it to be. Also, the government's putting a lot of money into the training side, the education side, to try and skill up the workforce so that it's better prepared for the post-COVID environment. I think this is an important thing that government can do and should do. So offering free training places for school leavers and job seekers, so while they're out of work, but getting skilled up. And there's also an incentive to hire apprentices and trainees, people on a traineeship. So the government will cover 50% of the apprentices or the trainees' salary for, I think, a year. So I think if you're in that sector, that's going to be positive. But also I think should note that traineeships are quite broad and can even cover things like IT, so people who go through TAFE and do IT. Infrastructure. So there's a question here about JobKeeper hire credit not available to employers who are claiming JobKeeper. I haven't seen that, but we can check that out. Infrastructure. So in addition to the normal infrastructure spend, the government's putting forward another $14 billion designed primarily to accelerate new projects. And some of those projects are listed there, so one for each state and territory. So they're sort of what they call the shovel-ready projects. You can see there we've got a little shovel and a little bucket there. The government's also putting quite a lot of money into what we would term repairs and maintenance.
And the sort of repairs and maintenance work is actually going to produce shorter-term economic benefit to some of these longer-term infrastructure projects. I remember a story from Lindsay Tanner, who was a former finance minister, and he was talking about the recession of the early 90s. And at the time, the Keating government announced this big infrastructure package, and in the early 90s, part of it was about rail, and there was a big rail spend. But it took because of capacity constraints, it took a few years for at least the railway sleepers to be ready. So the railway sleepers for this infrastructure spending was only available 3 years after the recession had ended. So this goes to show that some of this infrastructure spending is not necessarily going to build us out of this recession. But to focus in on repairs and maintenance, like road safety upgrades and money for local councils will, because that's stuff that can be done. There's no long approval process. You just go off and do it. But it is interesting to note that the government has put it as a take it or leave it option to the state governments. So the Treasurer said last night, if a state drags its feet, another state will get the money. So they're putting the pressure on the states to get moving quickly on this money. And they want this work to start, not stall. It's another quote from the Treasurer. The states and territories will be expected to identify such projects that can be delivered quickly to produce short-term economic stimulus. So they're going to push things forward, but I think the major short-term benefits will come from some of those safety upgrades and local council spending money. The environment. I said at the start that this was a reactionary budget, not a visionary budget. And in that sense, the environment is probably not, there's not much in this budget for the environment. There's a few things which are listed there. Plastic tyres, pavement waste will no longer be able to be exported, which is probably, I think there's very little exporting that material at the moment since China stopped taking it a few years ago. But they're also putting $250 million in to help boost the domestic recycling industry. So there is a few things for the budget, in this budget for the environment, but there is space to do more, and we expect that maybe in future budgets the government will look to do more. So there is a missed opportunity in this budget around the environment, but I think we might see more on this in the future. Superannuation is a bit like the environment, where there's really very little on superannuation in this budget. There were some speculation around whether they would extend early access to super by another 10,000 or another amount. That wasn't announced. There was also speculation around the super guarantee and whether the government will delay the increase. On that front, the government has been silent. So, as we all know, the increase in the super guarantee charge is legislated. So, unless we hear something very soon, we have to assume that the super guarantee will go to 10% in the not too distant future. Also on superannuation, you may probably have heard that the government is running a retirement income review. That review hasn't finalised yet. And once that review finalises, we might see a few more announcements on superannuation. We also note that the Hayne Royal Commission, the implementation of the recommendations of the Hayne Royal Commission have also been delayed somewhat by the pandemic. And so we might see more on superannuation in 7 months' time, 7 months' time being the next budget. So there are some small things around portability of superannuation accounts to reduce what happens where people start a new job and set up a new super account each time. So CPA Australia's view on the budget. I think it's positive that it is expansionary and it takes some bold steps in certain areas, particularly around the personal tax cuts and encouragement for capital investment. So I think in that sense, they hit the right tone. The positives definitely, in our view, and Eleanor mentioned these, is bringing forward the personal tax cut is something we asked for. The introduction of temporary loss carryback is also something we've asked for, and we note that many other economies around the world have introduced temporary loss carryback to help previously profitable companies. Infrastructure spending is also positive, particularly the money going to repairs and maintenance and also regional Australia. The focus on jobs creation is very much a positive and will be essential to try and keep down long-term unemployed. Eleanor spoke about the expansion of the instant asset write-off and a removing of the cap on that. That is also a positive. Again, in talking to business, at the smaller end, a lot of businesses are not looking to make capital investments at this stage. But this measure does flow through to 30 June 2022, so that may be in a 12 months' time, may be beneficial to those businesses. We've asked for virtual AGMs to be made a permanent feature of the system, and they're going to do that. And as Eleanor said, the increased support for R&D is very much welcome. On the missed opportunity side, again, as we said before, this is not meant to be a visionary budget. So some of the big visions for the future of this nation are not captured in this budget. Some of the big reforms needed to improve the competitiveness of Australia are not captured. So tax reform is not mentioned, nor is, and part of that is around reduction in the corporate tax rate. I did mention about the environment and sustainability. That is not also addressed in this budget. In terms of other missed opportunities, which are more could really benefit business now, so I'd say these are real missed opportunities. A lot of businesses are very much, they're not in the growth phase, they're in the recovery phase. And those businesses need advice to reimagine and reinvent themselves, as they progress through to the growth phase, if at all. There's no incentive for business to go and seek that advice. And we know from members in practice that some of their clients are struggling to pay for that advice. For those clients that are struggling to pay are actually the ones that really need that advice to make the best decisions for their future, whether that's growth or a restructure or even, in some instances, business closure. The other missed opportunities around greater support to help small business digitise. We know from our regular annual survey of small business that a digital small business, a digitally focused small business is more likely to be growing. And more likely to be growing strongly and more likely to be employing staff. We find that many Australian businesses, while their level of digitisation has improved in the last 6 months because of COVID, they're still a long way behind many other businesses. I think this is an area where government could really make a strong investment to help the small business sector. In the lead up to the budget, they announced about $30 million to support further programs around digitisation of business, digitisation training. They put that in comparison. Singapore, an economy that's around about a quarter to a third of Australia's size, they're spending the equivalent of 500 million Australian dollars on supporting their businesses digitise. We're spending 30. Just wanted to put that out there. And another thing, and Eleanor has been vocal on this in the media and with the government, is the lack of support for new businesses. As we all know, new businesses have missed out on JobKeeper, they've missed out on the cash flow boost, and they missed out on various state government grants. And we were hoping that in this budget that some of those wrongs will be corrected. Unfortunately for those new to small business, there's still no further specific assistance for them. Further updates. So we have produced a range of materials on this budget. We have a dedicated budget page. I think Kimberly may have put that in there already. And on that budget page, we have our media release. We have our reaction to the budget, which is in that media release. We also have articles in the black. We have an extensive summary of the budget through CPA Tax News. We also have an infographic to help explain the budget in simpler terms. And I encourage you to go to CPA Member Connect and join the conversation with your fellow members on the budget and to share your observations and your thoughts on the budget. And I'll pass back to Ketty to run the Q&A session.
Many thanks, Gavin and Eleanor, and there was a lot to cover in a short amount of time. And we do have a number of questions in about 10 minutes to go. So, Gavin and Eleanor, I will ask these questions, but noting that sometimes we know the detail is not quite through yet, so if we are waiting, please just flag that. One question's come through, will pumping all this money into our economy create significant inflation?
So that's a risk. That's always a risk in an expansionary budget, and that's something that obviously the Reserve Bank and others will be following. At this point in time, I think the inflationary risks are relatively low, but it is something that they'll be focusing in on. You might note that recently the US Federal Reserve changed its monetary policy so that instead of focusing on inflation, it's focusing on achieving full employment. So by that it means in the US, they will actually allow inflation to run a little bit above normal if that helps to achieve a higher employment. So we don't know whether in Australia they'll adopt that same policy, but we'll wait and see.
Thanks, Gavin. Another question's come through asking if we have done any modelling around Australia's sustainable debt level, either on a per capita basis or a percentage of GDP.
So CPA Australia hasn't done that. Various think tanks from time to time do put out that sort of modelling. But I think if you compare Australia's debt levels to other advanced economies, we are very much at the lower end of the scale. So it's not really, I've got to say, I'm not really worried about the levels of debt that the government's carrying at this point in time. Obviously, they have to remain prudent over a degree of prudence is required over time, but I'm not worried about the levels of debt. And when we hear many other economists speak, they also say that they're not worried about the levels of debt that government's incurring at this point in time.
And I think the challenge, Gavin, you're right, is that you've got so many different models and so many different factors and so much uncertainty that, you know, a comparison is probably the best way to monitor how you are faring against other economies. But also it's about focusing, really, we talked about this being reactionary and short term. At the end of the day, we want a healthy economy, we want a stable one. So if that means that we need to up the debt for a little while so that we grow the economy, so we grow the tax base so the government can pay it back, that's not a bad thing either. And I think Gavin's right, it's around, you know, where is that balance? You check yourself against others, and that's the challenge for policymakers around the world.
Thanks, Eleanor. And Eleanor, timely that you're coming, just a couple of tax queries that I might point to you. Do we have to amend returns already prepared for the tax loss carried back provisions?
At a really quick glance of the legislation, I would say no. It looks like it's going to be done through the 2021 and 2022 tax returns. So essentially you have a process where you claim the credits, much as you might claim, let's say, franking credits on the tax return. It looks like that's how it will be done. So there's no going back and amending returns and getting a credit or a refund immediately. It sounds like it will be done through the lodgement process for future years.
Great. And will expensing of depreciable assets include in-house software? That might be too much in the detail for the moment.
Yeah, no, let me just pull it up. I had it just before. Essentially, broadly, you know, in the EM, it's talking about they're broadly consistent, the rules with the backing business investment incentive exclusions. So they're the rules that were set a few months ago. And essentially, it's depreciating assets, but they can't be excluded from the UCA rules in Div 40. Or be subject to the capital allowance rules in sub-Div 40E or 40F. So that's where your low-value development and software development pools are, as well as primary production depreciating assets. So once again, as we work our way through the EM and the legislation, I think some of those questions will become clearer, but hopefully that helps.
And Al, just an extension of that, there's another question. Can you expense the purchase of a business?
Yeah, no, similarly, like it has to be a depreciating asset within the definition of the rules as they exist, so they believe so.
Great. A question, I'm not sure if this is for Gavin or for Eleanor, but do we know how you will apply for JobMaker? Will it be through a portal similar to JobKeeper?
Look,
Good
I
question.
don't have
It's not the ATO. Yeah, go Gavin.
Yeah, I don't think it's going to be the ATO. But yeah, look, we'll have to wait and see the detail. I haven't seen, apart from what's in the budget paper, and it's scarce on that sort of level of detail. So obviously that'll come out hopefully in the next few weeks.
I think what this highlights is the need for quick delivery. So that's one thing we've turned our minds to, that the government can make these announcements, but the capability and capacity of the delivering agencies and the intermediaries is so important. So, you know, the ATO is big and pretty good, and it still took them a while to get their systems up and running. And even now, we wouldn't say they're perfect. So when it's another agency which may not have experience, it's going to be a challenge. So like Gavin said, we'll wait and see.
Thank you, Al.
And it does start on the 7th today, so hopefully we'll see the detail very soon.
Thanks, Gavin. There's a question here saying, can you hold off on paying a tax liability from 2018-2019 against the current loss for 2019-2020 to the ATO to help with cash flows?
I think if I understand that, that's the same thing around the timing. I think it will be around that you only claim it in the 2021 return, so anything to do with the tax loss carryback won't crystallise or become a benefit until then. I don't believe that you can be doing anything now on a quick read of the legislation.
Thanks, Eleanor. And
sorry, I was just going to say the other alternative is maybe to discuss the payment arrangement with the ATO. That's separate from the tax loss carryback.
Thanks, Gavin, and a good point as well, because I know the ATO have been doing a lot of work in that space. Do we know any detail on how the source of the job let me start again. Do we know how people will source the job train at low cost or free training places? Do we know if this may be something through Centrelink, for example?
Look, it probably will not be through Centrelink. It'll probably be through your vet provider, your local TAFE. Would probably be where you'll get the information from, or an RTO. And I'm sure that some of these RTOs and TAFEs will start to provide information very soon on how to access this training.
Thanks, Gavin. And this might form our last couple of questions in a bundled amount. Eleanor, these ones may be for you. Can you write off an existing asset balance, and how much can you write off?
So with the new announcement, there's no amount really. So if you can access the full deduction, the temporary full deduction, and you qualify, the asset qualifies, then it doesn't appear that there's a limit. In terms of the instant asset write-off extension to June 2021, that is still a $150,000 cap, so depending on which you're using. But yeah, so I think really what the government's expecting is that businesses are going to make some pretty big investments, and really what they do is they gain the tax benefit or they get a front-loaded benefit on their tax by doing so. The government really wants to see investment, so it doesn't seem like they've put any thresholds on it.
Great, thank you, Eleanor. Look, I think we've only got a couple of minutes until we need to conclude the webinar. So with that, I'd like to sincerely thank Gavin and Eleanor for their presentation today, and also Kimberly for your help from in the chat box today and also with the presentation. I'd like to thank Peter Wilson for his opening comments today and joining us, as well as to everyone who's taken the time to come along and be part of our webinar today. We hope that you've had some key insights from our federal budget webinar. And as mentioned by Gavin earlier, please look out for our further updates through CPA Update, Tax News and In Practice, noting Tax News went out as a special edition in the very early hours of this morning. Please everyone stay safe, stay well. And with that, I'd like to close our webinar today and hand back to Linda. Thanks, Linda.
Thank you. I just wanted to take the opportunity to say a big thank you to our panel. So thank you there to Eleanor, Gavin, Kitty and Peter for a fantastic webinar. Special thanks to everyone for your participation as well as for your attendance today. That does formally conclude today's webinar. Go ahead and click on the cross on the top right of your screen to exit. Just letting you know, upon exiting, you'll be automatically redirected to a feedback form. You are initially taken to an external site message. Go ahead and click the blue continue button just to go through to the CPA Australia feedback form. It only takes about 30 seconds to complete. However, it's really, really beneficial for CPA as well as our panel. So please go ahead and leave us your thoughts. Just also letting you know that everyone will also receive a copy of today's recording alongside today's presentation. It'll be sent to you via email within the next 24 hours. Thank you once again, everyone, and please stay safe. Thank you very much. I'm going to pop on the music as you all exit. Thank you so much.